Hello everyone, today we're going to talk about Chapter 5, Accounting for Merchandising Operations. It is an accounting principle using the 9 Canadian edition, a Wiley Plus. Let's start the chapter. Chapter 5 has a learning objective, about 8 of them. Describe the difference between service and merchandising company. Prepare entries for purchase under perpetual inventory system, number 2. Number 3, prepare entry for sales and perpetual system using earning approach. Number 4, perform any remaining step in the accounting cycle for merchandising company. Number 5, prepare a single step and multiple step income statement. Number 6, calculate the gross margin and profit margin. Number 7, prepare entries for purchase and sales under periodic system using earning approach and calculate the cost of goods sold. Number 8, prepare entries for sales under perpetual inventory system. Accounting for merchandising operation means recording purchase of merchandise, recording sales of merchandise, earning approach, and completion of the accounting cycle, doing merchandising financial statement, as well as using the information in the financial statement. Learning objective number 1, describe the difference between service and merchandising companies. What are the things? Purchasing product to resell customers, the means of revenue is sales for merchandise. This is an example of the merchandising operations. Okay, called sales revenue or simply sales. Together of expenses will be cost of goods sold, cost of merchandise sold, operating expense will incurred in the process of completion of performance obligations. Gross profit will be the difference between sales revenue and CGS, cost of goods sold. This is the difference. Service company, it means you have service revenue minus operating expenses equal to profit loss. What are typical service company? It's like consulting, tax service, lawyers, doctors. That's a good example of service company. Merchandising company with sales revenue minus cost of goods sold equal to gross profit minus operating expense and profit loss. So you see the difference here between service company in terms of income statement and then merchandising company in terms of the income statement. Perpetual inventory system will maintain detailed records of inventory purchase and sales. If it is perpetually, it will show quantity and cost inventory that should be on hand on each item. Cost of goods sold is calculated and recorded at the time of the each sales. Flow of cost when using perpetual system. This is the typical merchandising inventory, perpetual system. Debit, you get the beginning inventory, okay, plus cost of goods sold purchase minus the one cost of goods sold. Every time there's a sales, you're gonna get inventory, ending inventory here. This is in terms of asset. In terms of cost of expense, cost of goods sold here, cost of the expense is gonna be debit side on the expense side. Operating system, the inventory costs are not kept throughout the period. The cost of goods sold is calculated only at the end of the accounting period. For periodic accounting, inventory equation to the CGS is like this. Cost, number 1, step 1, cost plus beginning inventory plus cost of goods sold, you're going to equal to cost of goods available for sale. Step number 2, cost of goods available for sale minus cost of inventory, then you're going to get the cost of goods sold. Okay, that's the logic here. So you got step 1, step 2. Okay, and then learning objective number 2, prepare entries for purchase under perpetual inventory system. And then when merchandise is purchased for resale, debit will be merchandise inventory for cost of goods sold. Credit will be account payable or cash purchases. For cash purchases will be purchase on credit, will be account payable. For cash will be cash purchases. The purchase is normally recorded when the purchase is received. Freight, FOB shipping cost. Okay, freight cost will be an FOB shipping. Purchase invoice indicates that ownership of goods is transferred from seller to buyer. What is FOB shipping point is that purchaser accept ownership at the place of shipping and pays for the shipping cost. Okay, the purchaser, okay, a place of shipping. Purchaser debit merchandise for the cost of shipping. Debit equal to merchandise inventory. cash is credited. Okay, this is FOB shipping point. FOB destinations, where the purchaser accepts when the goods are delivered to the purchase place of business and seller pays for the freight costs. Seller debit in terms of the expense for cost of shipping, delivery expense is debited, and cash is credited. For purchase and return and allowance, goods are purchased may be damaged or defective of inferior quality. It may not meet the purchaser's requirements. Good can be returned or purchase may be reduced on allowance. There are ways to enter it: cash or account payable debited, merchandise inventory credited for the amount of return of the adjustment. Quantity and purchase discount is that it is reduction in price according to the quantity being purchased. The purchase discount is the reduction of price due to early payment of the amount due. If I pay early, I'll get discount. So the way it's gonna journaling is like this: account payable is debited, credited will be merchandise inventory for the amount of discount, or cash for the amount paid, and cash for the amount of paid credit. This is a typical of journaling for early or get a purchase discount. Objective number 3, prepare entries for sales under purchase inventory system using earning approach. Okay. Used by company to that follow ASP. Revenue is recognized when the performance obligation on the part of the seller is completed and the amount of revenue can be reliable and measured. The collection amount due from the purchase is probable. Okay. There are 2 entries to record under purchase system. Number 1, to record sales revenue will be cash or account receivable debited. Credit will be sales. Okay, credited will be sales, will be credited on the credit side. And then to record of goods sold, debit is cost of goods sold, credit merchandise inventory. Sales perspective in terms of FOB destinations, seller pays the freight, not part of cost of goods sold. Instead, it is an operating expense to the seller. Costs is incurred to earn and are recorded as expenses. Sales return allowance, when the customer return merchandise to seller or credit or refund. Sales return can be because the product can have a defect or cannot usable or damaged when received. Okay, that's an example of sales return. Sales allowance is when the seller grants customer a price reductions. Okay, so sometimes you see the seller grants the customer a reduction because of the price matching. Okay, contra revenue, account sales, return, and allowance is used to provide information. So how are you going to book this? Sales entry required will be sales return allowance will be debited, account receivable cash will be credited. So okay, this is the play way doing it. Journal. Okay, journal entry. If merchandise return, it can be sold again. Merchandise inventory will be debited. Cost of goods sold will be credited. Sales discount. Discount offered at the early payment and the balance due. Discount amount taken is credited to sales discount, opposite to purchase discount. Original amount in sales is not changed. To record sales discount, cash is debited, sales discount is debited, account receivable is credited. Sales tax collected by merchandising company on the goods that they sell. Sales tax are collected are not revenue. It is treated as liability until paid. Okay, they are due to the government. Remember, sales tax are due to the government. It's not your own self. Okay, it's only collected temporarily. Periodically remitted to government. You have to provide usually either quarterly or every 6 months or every year. Depends on the size of the company you are doing. Data analytics on credit sales. There is a great reliance on company doing data analytics in order to support business decision. Many of the company uses Google Analytics or other analytical tools that are provided. Okay, credit sales and return and allowance, sales discount provide opportunity for use of data analytics. Example, gathering data is current and as well as potential. Customer can help company expand its sales base while minimizing risk on unpaid receivable. In terms of learning area 4, perform the remaining step in the accounting cycle for merchandising company. Completion of accounting cycle is the same type of adjusting entry of a service company. One additional adjustment for inventory to ensure the record of inventory amount agreed to the actual quantity on hand. A physical account is important to control the features. Okay, a persuasive system indicates that would exist. Inventory count will determine what does exist. So it has to have an inventory. I remember when I used to work for RGIS, every we are being sent to audit the Home Depot, we have to do a count of the inventory. Usually done every quarter or the end of the year. Additional account to be closed will be sales as return allowance, as discount, cost of goods sold, delivery expenses. So if there's any discrepancy between the inventory and the one in the system, we're going to call it the shrinkage, okay? Planning objective number 5, you need to prepare a single step as well as multi-step statement, financial statement. Merchandising income statement in a single step. Only step required to determine profit and loss, subtract total expense from total revenues. The main reason is simple and easy to read. Second reason, company does not realize on any profit until revenue exceeds total expense to make sure divided into this category. This is a typical single step. You got the revenues here, and then you got the expenses here. So this is a single step, guys. You got the revenue summing up, net sales, rent revenue, total revenues here, expenses from CGS, all the way to salary expense, all the expenses. You're going to total expense, you got the profit of the year. For multiple step, it is more common and useful presentation than a single step. It can report gross profit. There are 5 steps to determine the profit or loss of the company. The first one is net sales, which is the sales return, which is the sales less return, allowance, and discount. Number 2 is the gross profit, which is the net sales less cost of goods sold. Number 3, profit from the operations equal to gross profit or less operating expenses. Number 4 is non-operating activities, which is activities not related to operations. Number 5, profit equal to profit from operation plus minus non-operating activities. This is a typical multiple step income statement. You got the sales revenue here minus CGS, then you get a gross profit here. This is the typical calculated sales gross profit, and then you're gonna lump sum all the expenses. You're gonna get after you lump sum, you total the operating expense. Just accidentally pressed by accident. So this is, you operate all the expenses, you total it. You're gonna get operating expense total, and then you minus it from the gross profit. You get the profit from operation 30,000. And then calculate the non-operating activity and activity and profit. You're gonna put here differently other revenues, interest revenue, and revenue here, and the other expense here as well. So you're gonna profit of the year. That is a multi-step income statement. Our balance sheet will be on merchandise inventory. Report as current asset will be like this. Current asset, cash, not receivable, account receivable plus merchandise inventory here. And we're going to total it, it's 127, okay? Look at the honoring object number 6, which is calculate the gross profit margin and profit margin. So how are you going to calculate this? Based on the profit ratio, measure profit or operating success for a specific time period. Gross profit margin is gross profit expressed in percentage. The way to calculate is gross profit divided by net sales equal to gross profit margins. Here in this case, you got the 41.1%. Okay. Look at the next one. Profit margin is the percent of sales as the result in profit. It measures the ability of a company to cover all expenses and provide return to owners. The way to calculate profit divided by net sales. Here, you got a profit margin 9.2. And then at the object number 7, prepare entries for purchase and sales under periodic inventory system using the approach as well as calculate the cost of goods sold. The key difference between two perpetual inventory system is that calculation of CGS is only performed at the end of period when physical inventory is done. accounting entries are different as a result. Okay. When recording purchase merchandise, it is not used separate account and are used instead. Merchandise purchase are debited to purchase account. Freight costs are debited to freight in account. Return allowance are credited to purchase return allowance account. Discount are credited to purchase discount account. Okay. How are you gonna book it? At the time of sales, so only sales are recorded is that debit account receivable debited, sales will be credited. There's no entry made for the recognition of the cost of sale. Freight costs as return allowance and sales discount are treated the same as under perpetual inventory system. The calculations will be here of the goods sold is performed at the end of the period. The equation will be shown up here. Step 1, cost of beginning, inventory plus cost of goods sold equal to cost of goods available for sale. This is step 1. It's moving up to the step 2, cost of goods sold available for sale minus cost of inventory, then you get the cost of goods sold. In terms of the components, will be cost of goods sold purchase by adding purchase and freight in, subtract the purchase sales and return allowance to purchase discount. That is the cost of goods purchase. And for the cost of goods available for sale, based on the beginning inventory plus cost of goods purchased during inventory. For ending inventory, based on physical count of inventory or number of units counted plus unit cost. This is a typical multi-step process. You see here, so revenue, sales, and sales discount, the detail here, and you got net sales, you got the CGS here, and then you got the calculate inventory and purchase, last purchase, and discount here, and then net purchase, and then add all the costs here. You get the gross profit. After that, this is a calculation of net sales or CGS. Then you're going to total all the operating expense, you're going to get profit from operations, and you're going to add up a total revenue for the non-everything one. So this is more complex, more complicated. Excuse me. Completing the accounting cycle, regular costing, entries for all purchase and sales, discount and allowance, freight. The way to calculate this: income summary, debited, credit, merchandise inventory. Another entry required is that merchandise inventory debited, merchandise inventory debited, income summary credited. Objective number 8, prepare entries for sales under perpetual inventory using contract-based approach. All the entries depend on whether the company follows IFRS or SPP. Again, Canada most likely use IFRS. This is the standard way of doing things now for all big corporations. Okay, contract-based approach used by companies that follow IFRS, International Finance Reporting Standard. IFRS stands for. Revenue is recognized when purchase of goods and transferred to the purchase, and the amount is recognized as revenue reflect the consideration of the business expect to receive. There's 5 steps of revenue recognitions. Okay, based on obligations and right obtained entering into the contract with the customer. Sellers has to perform obligation in delivering goods and receivable and enforceable right to receive considerable payment from the purchaser. In order to receive the revenue, seller must determine transaction price. Okay, and taking into regulation sales return. What are the things? When right return exists, revenue is reduced at the time of sales, and the sales recorded at the amount not expected to be received. A sales discount is a potential reduction in revenue and is occurs at the time of sales. If customers do not take the advantage of discount, increased revenue is recorded. So this is accounting for the freight, cost, sales, and adjusting entries. Costing entry are the same as those of the company using the earning approach. So the current base for the multiple steps are classified into the balance sheet prepared the same way as the earning approach. There are 2 additional account balances such as estimating the returns and refund liabilities. As number 2, the accounts not recorded for income statement will be sales return, allowance, and sales discount. So this basically summarizes the multi-step step. There's a copyright here done by John Wiley, 2022, Sons Plus. So this basically concludes chapter 5. So hopefully we can see you soon. Okay? Bye-bye. Thank you.